All right, Dan, you've been very patient. Thank you for standing there this whole time. Let's get into what's going on in the investment world. 2011 has been pretty good from talking to these guys on the leasing front. Tell us about the investment market.
Well, thanks for that. I'm also concerned about the patience of our audience. So those of you who know me well know I can go on. I'm going to do this very quickly. I'm going to talk both of what we think happened in 2011, and there's a part of my comments that predicts what's going to happen in 2012, and we may just skip over that, and if it comes up in questions, we can talk about it. But the real big picture in 2011 is much greater activity. And just hearing what the panel has been talking about, what we're hearing again and again are improved fundamentals. And this was reflected first in the A, institutional quality market in 2011. We're going to talk about what happened in the B market in a second. This chart basically is a little complicated. The point is that institutional investors price assets based on their internal rate of return projections over a 10-year unleveraged period. That's the apples to apples measure. And we always talk about cap rates in the investment world, but certainly in the case of institutional investing, cap rates are important, but they're largely derivative of these yields. So what happened in 11 is the institutions who did most of the activity ended up in cap rate ranges in internal rate of return targets between 6.5% and 7.5%, and with leverage, inexpensive money, and with the when used, but more important, with the projections of income growth, it allowed these institutions to buy assets at cap rates between 5.5% and 6.5%. It's very interesting to note that in 2009, there were only 22 open-air shopping center deals in all of California above $10 million that closed, whereas in 2011, that number increased to 49. What was really interesting to me was, of that number, 33 were institutional quality deals. With the smaller number, the remainder, only 16 were non-institutional B+ or C properties. It's interesting that also that a lot of the activity happened outside of Northern California. This area has always been very stingy with regard to bringing on high quality product. But we can show you a few deals that closed. Most of you are familiar with them. Alameda Town Center closed at the beginning of the year at around a 6 cap rate. Developed by Harsh as a private capital repositioning, acquired by Jamestown as an institutional, stable asset, income certain deal. Very interesting to all of us is that at the end of the year in December, Safeway closed a offering. They had put on the market 4 properties of very, very high quality, institutional quality product they had developed. 3 of them closed in December of 11. 1 is remaining to be closed. 3 were in California, 2 in Northern California. And both the Safeway deal in Burlingame and the Safeway deal in Dublin, they all got priced as a package, reportedly about a 5.4 cap rate. The overall deal over $100 million. Closer to home, James was talking a little earlier about Merlone Geyer's deal in San Antonio and mentioned the Whole Foods directly across the street. This is a listing of mine that, while not sold at this point, attracted all cash offers from institutional pension fund type buyers in the 5.5 to 5.75 cap rate range. And finally, we will be hearing about Potrero Center, which went into contract in 2011, will close in early 2012. Quite a bit of competition among the pension fund and REIT world, and its cap rate is reported to be in the mid or low 5% range. Again, a transaction well over $100 million.
Okay.
Turning for a moment to the private capital world, what does that mean? It's every deal that's not perfect. And Garrett talked earlier about this big gap between A property and everything else, and it was really pronounced in 2009 and 2010. And what we saw, certainly in the beginning of the year, were cash-on-cash yield demands or targets above 9%. For a deal to close, it had to produce that out of the box on a leverage basis, which equated on a cap rate basis to deals between 7.5 and 8.5%. Now, mind you, these are B properties, but this could be a grocery-anchored center that is in a B location, or it could be a shadow-anchored center in an A location. For one reason or another, it wasn't good enough for pension funds or the higher REITs that had a higher quality objective. When you go to the next level, it really falls off the map. This is B- and C product, where probably you might be in the valley, you might not have an anchor, you might have vacancy, there's income, but the yields that are demanded by the investors start at 10% and go to the mid-teens from there, resulting in cap rates really in the 9 to 13% range. And it's interesting to note, while money is very inexpensive and it allows positive leverage at these cap rates and very, very substantial cash-on-cash yields, if you're willing to take the bet that that income stream is not going to decrease. But across all product types, whether it was A, institutional, B+, not quite right, or C and below, in every case, all investors were pricing off in-place, predictable income. And basically no value has been given to vacancy per se. Finally, not everybody who does real estate investing in retail just looks at multi-tenant. There's a huge market in Northern California for triple net properties, single tenant. And luckily, our parent company, Cassidy Turley, has a very powerful and active triple net group. Many of our colleagues are here in this room. And from them, we've been able to get some really good trends. And what we saw is that for high quality, you think of sort of Walgreens as sort of the gold standard or a credit deal with some bumps. The investment world in the Bay Area was taking in the 6.5% range to 8% range for triple net deals. Interestingly, on a cash-on-cash yield basis, it was a much broader range because if the deal was large enough and an investor wanted to utilize leverage to get a larger deal, the triple net buyers, unlike every other kind of multi-tenant buyer, was willing to accept negative leverage, and if they could get a 5% yield on quality, it certainly beat paying taxes on the one hand and 2% T-bills on the other.
Okay, Dan, pretty interesting. Who's buying this stuff?
We're going to put a chart up here now. The number of buyers who really did volume can be seen on this chart. And it's very interesting. The number one buyer for by the way, I should add, this is not Northern California. This is kind of the West Coast. And it's meaningful because the markets operate as one market. If it's an A product in Seattle, it's an A product in Seal Beach, it's the same buyers, it's the same tenants. And so the trends are relevant. And so if that product were here in Northern California, you'd see it being absorbed here. But so this covers a broader geographic area. And the number one investor by far was Equity One. And this was composed of what was it? 6 independent deals they did, but it is important their acquisition at the beginning of the year of Capital and Counties, creating this $665 million volume. TIAA-CREF, pension fund advisor, did 3 deals and equaled the value of the 6 that was done outside of Capital and Counties. And I don't have to go through the chart, but what's interesting to me is this chart is composed of 2 groups. And those groups are pension funds and REITs that are buying A-quality product, and buyers who've come back into the market late in 2010 and 2011, who I don't want to say are add value buyers, but they're buyers who see that this shift in fundamentals that we've heard today is really taking place. And they're believing that the income streams they're buying are solid and aren't going to go away, and the leverage yields they can get on in-place income are very attractive, and in addition, believe that it is logical when the general knowledge of this fundamental improvement becomes widely known that there will be cap rate compression in the higher B-plus quality product.
Can you give us a quick comment on what you think is going to happen in 2012?
Well, I think there's going to be cap rate compression across the board, except with respect to C product. Where C product, because no one knows what's going to happen to the rents. They could get worse before they get better. This chart, I'll look through quickly. I already talked about the IRR targets that we saw in 11. The red bars are what I think is going to happen in 12. And of course, every time the IRR target goes down, the acceptable going-in cap rate will go down with it. For the B-plus product, this was the cap rate range. And, the cash-on-cash target range in gray and the resulting cap rate in red. You can see, again, a 50 to 100 basis point decrease. When we go to the C product, there's probably some decrease. And that's totally based situationally on deals where there's good fundamentals or you can handicap some improvement. But by and large, it's going to remain unchanged. And based on the input I've gotten from Cassidy Turley's triple net group, I think we're going to see additional cap rate compression in this sector as well, as there's a lag in the development of new supply by single tenant developers. At the same time, there's more sources of money and a growing frustration with the investment alternatives, largely in bonds and T-bills.
All right, great, thanks. Okay, let's move quickly to some closing statements from our panelists. Jim, give us kind of your final thoughts, 2012.
For the first time in a long time, we can be part of a positive upswing. Our existing inventory, albeit at a slow pace, is being absorbed, and that's good. And hopefully we can get back to a competitive environment.
Great.
I always quickly cling to a statistic that I think you might want to think about tonight is California has 38 million people, and by 2050, it's expected to have over 60 million. So they've got to go somewhere, hopefully in my neighborhood.
Going to be a little crowded out there.
Right.
John, talk a little bit about closing comments on shop space.
Sure. I expect vacancy levels to drop a bit in the shops and pads arena. I think rents will increase a little bit, not much, but slightly. And I think the quality tenants will continue to battle over those A-plus locations in the A centers. So this will force other tenants to go to the B and C centers, ultimately.
Okay, James, close it out on the box and the ground up stuff. There's a lot going on. What can we expect?
Sure. I think grocery and general merchandiser requirements will continue to drive development, most likely with some form of residential component to help underwrite rising land values and general plan requirements. And on the second generation space, as the absorption continues, it's only going to put more pressure on the Class B product. And I think will even put more pressure on the development side and repositioning of existing assets, including office R&D product and industrial sites.
Okay, great. And Rhonda, closing thoughts on San Francisco?
I think we'll see rents remaining firm. I think we may start to see more office users compete for ground floor retail space. I think we'll see continued demand for large footprints of 30 to 80,000 square feet. And this, combined with our low vacancy rate, should start to drive some more new construction.
Okay, great. Dan, closing thought on
I think we're going to see
investment
further cap rate compression, but minor in the A product with a tremendous demand, pent-up demand. I think the most significant trend I think we're going to see is finally cap rate compression in the B and B plus product. I think there's huge opportunity there. And finally, I think those developers that are doing the projects James showed us out of the ground are going to be pretty happy when these decreasing IRRs and cap rates are going to make them a lot more money than they thought they might have made.
All right, panelists, thank you. Great job, good in-depth stuff. I'm mindful of our time. Do we have any questions that we want to? Okay, you know what? Tell you what, Dan, you want to answer this question for us real quick?
I think it's complicated and it has two sides to it. You know, we all know that redevelopment agencies funded a lot of infrastructure for development, and that's going to be in a jumble for quite a while, whether the cities decide to take over that role or not. So I think it's going to be in one way harder to get these deals done. Further, I think the cities who now don't have the use of that money and see a slowing of development might even go for more extractions from developers. But I think by and large, it's going to be retarding a development for a period of time.
James, why don't you attack this a little bit?
All right. Well, this question, I think, violates a little bit one of the basic laws of economics, because with this increased inventory in the marketplace, you would think there would be a softening of rents, and when in fact, it's really going to be contrary to that. Again, I think, as you've seen with our presentation today, it's all location, 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 and these new projects, and particularly these new developments, are really going to be commanding top-of-the-market rents, most likely from the national credit tenants, but those rents will continue to either stabilize or increase.
Okay, great. All right, thanks, guys. All right, so thank you all for being here. This has been, fun for a lot of us. Hopefully you got a lot of information out of it. Please don't forget iPad, Terranomics quarterly reports, everything on our website. Next week, this report will go up on our website, so please look for it if you want to pass it along. And, lastly, thanks again for joining us. Thanks for choosing us and not Obama, and even though you had to deal with his traffic. And please stay. We've got this great view. We're going to have, drinks and dinner and enjoy each other's company in this great spot. So thank you, and have a great night.